Now that we have seen some of the applications of moving averages, let's also take a look at some of the problems which comes along with moving average. So as I was showing you, moving averages work great in trending markets, but they will start producing whipsaw signals like crossovers and then cross unders and likewise, and slow in sideways and slow moving markets. Hence, knowing when to rely on moving averages and when to ignore them is very, very important. So you have to rely on moving averages primarily when you know that there is a strong uptrend or downtrend. Then that's a time when they work really best. And when the market is like flattish sideways, you should avoid relying on moving averages. Secondly, they lag the price action and hence produce delayed signals. So since moving average are essentially average of the previous values, previous like 20 or 50 or whatever, right? So it's always a lagging indicator. It will only give you what price is doing. It will only tell you what the price is doing based on the historical data. So many times what happens, the signals it produce, they are very late. By the time you see a price crossing above moving average, let's say, a lot of move has already come in the price. So and that you have missed because you have been waiting for price to go above, let's say, moving average or below moving average. So you will get many of times like late entries, and same thing might happen for exits when price, if you're in long trade, the price has already fallen a lot before it goes below moving average. So whatever profits, if at all you are making, those are already gone, most of them. So you will get late entries and late exits if you are relying, too much on moving averages. And finally, moving averages do not help you in any way to predict future price moves. So they do not have any kind of prediction capabilities. Some of the other indicators, even those they are lagging indicators, but they could still give you some kind of forecasting capabilities, but moving averages, they do not do that. So now that we have seen some things about moving average, let's also kind of cover some practical aspects uh, of using moving averages in trading. So now different assets they may respond differently to different periods, right? And also to type of moving average like exponential or simple moving average. So you should not stick to, let's say, if you are using, let's say, 10 different or 20 different assets. Maybe you are using cryptos, maybe you are also using stocks, trading stocks and like forex and everything. So cryptos by nature they are more volatile, right? So a specific kind of moving average might work well for crypto, but the same moving average may not work that well for stocks because stocks are relatively less volatile. Not all of them, but most of them, right? So as an example, for more volatile assets, we should prefer smaller periods and EMAs because EMAs are quicker to respond to volatile moves and get timely signals. And for less volatile assets, you should stick with higher period. When I say higher period, does not mean like 10 times higher period. It could be like as simple as for more volatile assets, you might be using, let's say, 9, 10 period, and for less volatile assets, you might be using 20 period, 21 period kind of thing. Then another thing is slope of a moving average. It provides a lot of clues about the strengthening or diminishing. So when the moving averages go flat, right? I mean, as let me show you in a chart. So yeah, here in this zone, right, you can see this 200 period moving average, but this is a very large period. So that's why even despite this being flat, there has been a lot of activity here. But you can see during when this was flat, there were a lot of false signals like, price, there was a cross under here, then above here, then again here. So these kind of signals are whipsaw signals. So when you see a moving average going flat, right, you should avoid relying on moving average signals, because that means there is no clear trend. You should always use the slope. So now you can see that there is a slope, nice slope here, downward slope in this 200 period moving average, and the stock has moved nicely. So, and when here we can see there is a positive slope, and then stock moved up fairly, not like very well, but it was okay, and then continued moving up despite this fake crossover here. So slope provides a lot of clues, so you should always pay attention to the slope of moving averages. You can also use multiple moving averages, one short, medium term, and another longer term, to validate current trend instead of relying on just one MA. So for example, we say that, okay, when the price is above 200 MA, we are in an uptrend. So instead of just doing it, you can also use two moving averages, just like in this case, we are using 50 and this. So when the price is above both of them, then you should be bullish. As soon as the price goes below any of these, you say that a trend might be changing. So right now, if you are using only 200 moving average, you will exit when the price goes below here. But if you are using two moving averages, you will exit here itself, because you saw that the trend is probably diminishing here. So this is the way you can kind of make moving averages more effective by sticking with two moving average. So for example, here in this case, we are using both of them. So we know that trend is downward, but as soon as the price goes below both of them, here in this case, you can take an entry and stay in this trade till it goes above any one of them. So here it came above this. So from here to here, you would have got a nice move. And then you will not go long here because this trend is still down. You will only take short trades here in this case. So when the price crossed below this 50 moving average, you could again take a position. In this case, it may not have worked that well, but you get the idea, right? Using two moving averages is probably better than using one moving average for trend confirmations. And finally, avoid using solely moving averages for generating buy and sell signals. Combine them with either price action and or other indicators. So that's the same thing as I was saying earlier, that using moving averages on their own may not work well most of the time, because they work only well in trending markets, and markets are typically trending only 30%, 40% of the time, maybe less than that. Rest of the time the markets are mostly sideways and moving very, very slow. So you should not use them, even though you can, if you want to, by using crossovers and all those things, but you should still not use moving averages for generating buy sell signals. Always give attention to the price action and combine moving average along with that. If it confirms that, okay, what you were thinking is also being shown in the moving average, then definitely go with it. So that's all for moving average. I know it's been a long session, but there was no other way we could have made it shorter, because it's very, very important. See you in the next session.